Hello, everyone. This is Dr. Kenneth Ta. Today, we are going to consider Chapter 3, which is analyzing financial statements. Analyzing financial statements. In this chapter, we'll look at ratio analysis. We'll study different types of ratios. We'll do common size statements. We'll do the Dupont equation, and we'll look at the limitations of financial ratios. As an overview, financial ratios are extremely important because they tend to facilitate two things. They facilitate comparison of the company's performance over time, what we call time series analysis, and they also facilitate comparison of the company against other companies. It could be against a company in the same industry, a major competitor, or industrial average. So when we are comparing the company's performance for a current year against industrial average, that is what we call cross-sectional analysis. Ratio analysis are used by a variety of persons. Lenders are very interested in the ratio of the company. They use it to determine the credit worthiness of the company so that it can inform them on whether to invest in the company or not. Stockholders also use ratios. They use it to estimate the future cash flow and risk of the company. This will inform them whether they should continue to hold equity position in the company, or for potential stockholders, is going to inform them whether they should invest in the company or not. Managers are also interested in ratios. They use it to identify areas of weaknesses and strength. They can hold on to their strength and improve in the areas where they have weaknesses. Every company is required to produce financial statements. Corporations do their financial statements. There are three major types of financial statements. We have what we call the income statement, the balance sheet, and the statement of cash flow. The income statement reflects company's performance during the period. So for example, this is income statement for 2019 and projected income statement for 2020. So it captures the performance of the company for 2019 and the projected performance for 2020. We also have the balance sheet. Balance sheet can be defined as a snapshot of the company's financial position on the last day of each year. A snapshot of the company's position as at December 31st, 2019, or a snapshot of the company's financial position as at December 31st, 2020. So this is the asset side of the balance sheet. We also have the liability and equity side of the balance sheet. So we are basically going to use the income statement and balance sheet to do our ratio analysis. These are all the data that is going to help us: earnings per share, dividends per share, book value per share, dividend, numbers of share, year-end stock price, etc., etc. All right, the first set of ratios we want to compute is what we call profitability ratios. Profitability ratios. Profitability ratios are actually the net result of the company's policy and decision. How company's policy and decision show itself, the result of all of that. It provides an overview of the firm's operation. So these first two, the profit margin and the operating profit margin, they answer the question, what is the company's rate of return on sales? Then the other three ratios, the basic earning power, return on asset, return on equity, they answer the question, what is the company's rate of return on asset? So we'll go to the first, which is profit margin. Profit margin actually give us the profit per dollar of sale, the profit per dollar of sale. So profit margin, the formula is net income divided by sales, net income divided by sales. So in calculating this, we are going to go to our financial statements and we'll look for net income and sales. So if we go backward to the income statement, this is income statement. I can see here that for 2020 sales is 6,600. That amount is needed, and I can see that net income is 390. Net income is 390. So I can bring that in calculating this. Net income is 390 divided by sales, which is 6,600. So that gives me a net profit margin of 5.9%. 5.9%. So this is how we are going to calculate these ratios. We look at the formulas and then we go to the financial statement. We pick the amount that is associated with the variables needed and we do a computation. So once we have the computation, we can do time series and cross-sectional analysis. So time series basically is for us to understand how the company is doing with respect to time. So in 2018, the profit margin was at 6.7, and then the company dropped significantly. They are doing poorly in 2019, but they improved again slightly, not to where they were in 2018, but an improvement. So time series, we can say the company is okay. And then cross-sectional analysis, we compare for 2020, the company's performance with the industrial average. And we can see that the company is performing below average, So for 2020, the profit margin is 5.9%, whereas industrial average is 7.2%. So we will say cross-sectionally, the company is performing poorly. So this is how we will analyze the other ratios. If we begin to see that in so many areas or a number of areas, the company is doing poorly, then that company needs significant improvement. Or if you are a loan officer in a position to make a recommendation whether the bank should extend loan to this company or not, you will not be willing to make an approved recommendation for a loan if you find that the company is performing poorly in many different areas. All right, so that is the first profitability ratio, which is the profit margin. The second is what we call the operating profit margin. The operating profit margin is computed as earning before interest and taxes divided by sales. So this tells us company's performance with respect to its operation before the impact of interest expenses. If we go to the income statement, we can see the earnings before interest and tax, and sales we already said is 6,600. So let me go to the income statement, and what I'm looking for is the earning before interest and taxes. Earnings before interest and taxes in this income statement is 620. And we had seen before that sales is 6,600. So those are the two that we need. So which means we can now come back and insert what is needed so that we can calculate the operating profit margin. Earnings before interest and tax, we said is 620 divided by sales. Sales is 6,600. So this give us operating profit margin of 9.4%, 9.4%. And all of this is for the year 2020. So we can again do time series analysis. We see that the company dropped as we move from 2018 to 2019, but there's an increase of operating profit margin. So this is operating profit margin. So we can say the company is doing well over time. But as far as cross-sectional analysis is concerned, where we are comparing the company's performance against industrial average, and we can see that the company is below industrial average. So here we can say the company is performing poorly. All right. The next profitability ratio that we want to calculate is what we call the basic earning power. The basic earning power. This ratio shows the earning power of the firm's asset before the influence of taxes and leverage. Before the influence of taxes and leverage. The formula in calculating the basic earning power is earnings before interest and taxes divided by total asset. Again, we go to the financial statement. In the income statement, we are going to get earnings before interest and taxes, which we had said is 620. We go to the balance sheet, we can find the total asset, which is 5,000. So if we take 620 divided by 5,000, that gives us a basic earning power of 12.4. So this is a profitability measure. So the higher, the better. Time series analysis, the company seems to be doing okay. Again, a drop as the move from 2018 to 2019, but an improvement as the move from 2019 to 2020. But in comparison with the industry, which is what we call cross-sectional analysis, we see that the company in the year 2020 is performing below industrial average. So we will say the company is performing in a poor fashion as far as their basic earning point is concerned. All right, so we next need to see how we calculate return on asset and return on equity. Return on asset is the ratio of net income to total asset. So return on asset is net income divided by total assets. So if we go to the income statement, net income is 390. We go to the balance sheet, we'll be able to see total asset, which is 5,000. And if we take 390 divided by 5,000, that gives us 7.8%, 7.8%. So that is return on asset. We can also calculate the return on equity. Return on equity is the ratio of net income to common equity, So it is net income divided by common equity. So it tells how well shareholders are doing in an accounting sense. So we can go to the financial statements. The income statement, we'll be able to get our net income, which is 390. The balance sheet will get our common equity, which is 3,200. So that leaves us with 12.2%, 12.2%. So for both our return on asset and return on equity, we are given the values for 2018, 2019. We just calculated the value for 2020. We can do a time series analysis. We find that the company seems to be doing okay, but as far as cross-sectional analysis is concerned, the company is below industrial average. Return on asset is 7.8, industrial average is 10.8. And for return on equity, the company is at 12.2, while industrial average is at 15.5. So time series, okay, cross-sectional analysis, the company is doing poorly. So they need improvement. All right. So the effect of debt on return on equity and return on asset. So debt tend to lower return on asset, but it increases return on equity. So if we think about return on asset, we have said that is equivalent to net income divided by total asset. So if debt is going up, then is going to mean that net income is going to go down. And if net income is going to go down, then return on asset is going to go down as well. So debt tends to reduce return on asset. As far as return on equity is concerned, it is net income divided by common equity. So if the company is turning more to debt, that implies that there is less of common equity. If there is less of common equity, we expect that return on equity is going to go up. So we will say return on equity is lower by debt, whereas return on asset is lower by debt, whereas return on equity is going to increase with the use of debt. All right, so those are the different profitability ratios. So we want now to look at asset management ratios. So to understand a company using ratio analysis, we need to look at ratios on different aspects of the company: profitability, asset, debt-wise, market-wise. So we've seen profitability ratio. The next set of ratios is what we call the asset management ratio. So this actually will tell us how efficient the company is doing with respect to their assets. How efficient does the firm uses its asset? All right. The first asset ratio we want to look at is what we call inventory turnover. Inventory turnover. So inventory turnover is actually the cost of goods sold plus other expenses divided by inventories. So if we go to the financial statement, we'll find that the cost of goods sold is 520.10 plus other asset, which is 370, divided by inventories, which is 660. This implies inventory turnover is 8.5. Inventory turnover is 8.5. So we want a high inventory turnover, which means that inventories are going out fast. They are quickly converted into sales. The higher, the better. As far as time series is concerned, the company has improved from 6.2 to 8.5. So over time, the company seems to be doing okay. So time series say okay, but cross-sectional analysis, we find that the company is below industrial average. The company is below industrial average, which means that the company is not doing well. The company is not doing well. So we will say this is poor as far as cross-sectional analysis is concerned. So if inventory turnover is low, if you think of a shop like Walmart, if they have a low inventory turnover, it means that there are lots of goods that are staying in the shelf. And with time, with a longer time in the shelf, there'll be spoilage, there'll be theft. So high inventory turnover is it's a good thing, whereas low inventory turnover is poor. So we've seen this, that even though inventory turnover improved from previous years, it remains below industrial average, which makes for a good time series analysis and a poor cross-sectional analysis. All right, the second asset management ratio is what we call days sales outstanding. Days sales outstanding is the average number of days from sale onto cash is being received. So the days sales outstanding is equivalent to receivables divided by the average sales per day. And this is going to be equivalent to 530. We can find receivables on the balance sheet, the asset side of the balance sheet. And the sales is given as 6,600 per day, which means we divide by the number of days in a year, which is 365. 365. So the day sales outstanding is going to be 29.3. 29.3. So this is the average collection period, the length of time it takes the company to collect cash on their receivables. So we want this to be low so that the company can quickly get money. The lower, the better. So if it is low, it means that the company is getting cash quicker. So if we look in terms of time series, so we find that the company seems to be doing okay because the day sales outstanding has dropped as the company moved from 2019 to 2020. So it is taking less amount of days for the company to collect their receivables. But as far as cross-sectional analysis is concerned, it seems it shows that the company is doing poorly. The industry is collecting their receivable in 28 days, whereas this company is collecting their receivables in 29.3 days. All right. The next asset management ratio is what we call the fixed asset turnover and the total asset turnover. So the fixed asset turnover is equivalent to sales divided by net fixed asset. So it tends to measure how efficient a firm uses its plants and equipment. So it is fixed asset turnover, how efficient the company uses its plant and equipment. Again, we go to the financial statement. Sales is 6,600 divided by net sales. Net sales is 3,700. So that implies the fixed asset turnover is going to be 1.8. We also can calculate the next ratio, which is total assets turnover. Total asset turnover is sales divided by total assets. So this measures the dollars in sales that are generated for each dollar that is tied up in asset. So if we look at sales, we will find 6,600 divided by total asset. Total asset is 5,000. So that gives us total asset turnover of 1.320. 1.320. So this is total asset turnover and fixed asset turnover, which measure how efficient the firm uses its plants and equipment. So we want a higher ratio. We can look at how the company is performing over time. We see an improvement, but we see that the company is below industrial average. So time series analysis, the company seems to be doing well. Cross-sectional analysis, the company is doing poorly. They are performing poorly. All right, so we have seen asset management ratios. The next set of ratios we want to look at is what we call liquidity ratios. So it answered the question, can the company meet its short-term obligation using the resources it currently has on hand? Are they able to meet up to service their short-term obligations? That is liquidity ratios. There are two major liquidity ratios we want to look at. The first one is what we call the current ratio, and the other one is what we call the quick ratio. So with the current ratio is the current asset is calculated as the current asset divided by the current liabilities. The current asset in the balance sheet is at 1,300. The current liabilities is at 700. That gives us a current ratio of 1.9. And then the quick ratio is basically an improvement of the current ratio. So it is basically current asset, and then we subtract inventory, we divide it by current liabilities. So the whole idea of this liquidity ratio is how the company can convert their current asset to meet up with their current liabilities. So we know that one of the assets that cannot be quickly converted into cash is inventory. So quick ratio, take out inventory. So quick ratio is going to be current asset, which is reported at 1,200 minus inventories, which is 666, divided by current liabilities, which is 700. That gives us a quick ratio of 0.9. 0.9. All right, so we can look at this time series and cross-sectional. There seems to be some improvement over the years, which means that time series, the company is doing okay. So the higher the liquidity ratio, it means that the company is more able to convert their current asset to satisfy their current liabilities. But as far as cross-sectional analysis is concerned, the company seems to be performing poorly. They are way below industrial average. So the liquidity position of this company is weak. All right, so those are the two liquidity ratios that we are going to talk about. The next group of ratios that we want to talk about is what we call the debt management ratios. The debt management ratios. They tend to answer question, does the company have too much debt? Another question that this set of ratios tend to answer is, can the company's earnings meet its debt servicing requirement? So in other words, how indebted is the company, or is the company able to service their debt? That is the whole idea behind the debt management ratios. All right, the very first we want to calculate is what we call the debt ratio. So the debt ratio is equivalent to the total debt divided by the total assets. And if we go into the financial statement, the total debt is 100 plus 1,100 divided by total asset, which is 5,000, giving us a debt ratio of 24%. So the debt ratio is 24%. All right, we can also calculate what we call the debt equity, or the debt to equity ratio, which gives us the percentage of the firm that is the percentage of the firm that is financed with debt. So the first one, which was the debt ratio, discover that this, what is below is total asset. So it tells us the percentage of the firm's asset that is financed with debt. Debt equity ratio, on the other hand, is total debt divided by equity. So this ratio gives us the percentage of the firm that is financed with debt. So total debt is 100 plus 1,100 divided by 3,200. That gives us 37.5%. 37.5%. All right, the next set of debt ratios we want to look at is what we call the leverage ratio, or the liability to asset ratio. So it's the extent to which the firm's assets are not supported by equity, So the formula is liabilities on total asset. So liabilities on total asset ratio is equivalent to total liabilities divided by total assets. So total liabilities is 1,800 divided by 5,000. And all of this is coming from the financial statement. So we have liability to total asset, which is 36%. 36%. All right. The next thing we want to look at is what we call equity multiplier, or the leverage ratio, So the equity multiplier actually comes from the whole idea that return on equity is equivalent to net income divided by equity. So we had established that. We had also established before that return on asset is equivalent to net income divided by total asset. So see how I can play with return on equity. So I can have return on equity to be equivalent to net income divided by, I can say, total asset, then I can times total asset divided by equity. Nothing has changed because I can cancel the two total asset. So nothing has changed. I can cancel this total asset and this total asset. If I do that, then return on equity is basically net income divided by equity, which is what we had established before. All right, so with this, what we find is that return on equity is the same as, so notice that this now becomes return on asset, so times, this is what we call equity multiplier. So equity multiplier is total asset divided by common equity. So equity multiplier is total asset divided by common equity. Total asset divided by common equity. Equity multiplier ratio is the factor by which the return on asset is multiplied to determine the return on equity. So notice the return on asset will be multiplied by the equity multiplier to generate the return on equity. So this is a leverage ratio. This is the leverage ratio which tends to improve return on equity once we multiply that with return on asset. All right. So if we now go to the statements, our statements will find that total asset is 5,000, common equity is 3,200. So that implies that our equity multiplier is going to be 1.5625. All right, the next ratio we want to look at is what we call the times interest earn ratio. The time interest earned, which is equivalent to earning before interest and taxes divided by interest expense. On the income statement, earning before interest and taxes is 620. Interest expense is 100. That implies our time interest earned is 6.2. 6.2. So time interest earned basically will tell us how the company is able to service their interest obligation. How the company is able to service their interest obligation. So notice that we have earnings before interest and taxes divided by interest expense. So it's how these earnings are able to meet up the interest expense. So the higher the tie, the better. So interest expense is one obligation of the company. The company can have many other obligations. So how is the company able to meet up with their other obligations? And that include depreciation and amortization, lease payment, interest expenses, loan payment. So the ratio that is used in calculating the firm's ability to meet other obligations apart from interest expense is what we call the EBITDA coverage ratio, the EBITDA coverage ratio. So the EBITDA coverage ratio, this is a bit mixed up, so let me write it here, is earnings before interest and taxes plus depreciation and amortization plus lease payments divided by interest expense plus lease payment plus loan payment So EBITDA coverage is equivalent to earning before interest and taxes, which is 620, plus depreciation and amortization, which is 370, plus lease payment, which is 20 from the statement provided, divided by interest expense, which is 100, plus lease payment, which is 20, plus loan payment, none is given, so it is 0, which means our EBITDA coverage comes to 8.4. 8.4. All right, so we can do cross-sectional analysis and time series analysis. So we can find, as far as time series is concerned, indebtedness, this is going down, which is good. So we can have a time series cross-sectional, time series analysis, cross-sectional series analysis. So time series improvement, so this is going down. So the company is less indebted. So this is okay. Cross-sectional analysis is very high for the company compared to the industrial average. So the company is more indebted compared to an average company in the industry. So this is poor. Indebtedness goes down, okay. Indebtedness is very high, which can lead to inability to pay on their debt obligation or bankruptcy. So this is poor. As far as liabilities is concerned, we find that liabilities to finance assets, that is going down. So this is okay. This is very high. The company is using liability to finance asset more and more. So this is poor. So this is how we walk down ourselves. And as we said, if we find that lots of these ratios are showing poor over time, then it will not be a good thing for the company. Will not be willing to extend loans to the company. So those are series of debt ratios. So let's go to the next, which is market ratios. So these market value ratios, they tend to relate the firm's stock price to its earnings, cash flow, and the book value per share. They're actually a way to measure the value of the company's stock relative to that of other companies. So market value, we expect that companies with high current level of earnings and cash flow, that is going to improve the market value ratios. We also expect that companies that are expected to grow in earnings and cash flow will be a positive thing, good news, so the market value ratios will go up. On the other hand, we expect that high risk of expected growth in earnings and cash flow is going to decrease the market value ratios. All right, so let's look at the first one, which is what we call the PE ratio, the price earning ratio. So the price earning ratio, they show how much investors are willing to pay per dollar of reported profit. How much investors are willing to pay per dollar of reported profit. So we have price per share that was given to us under other information. The stock price is at $49 per share as at 2020. Then we have the earnings per share that is given as 3.9, which means that the PE ratio is 49 divided by 3.9. 49 divided by 3.9 will give us 12.56. Okay, so that is the first market ratio, which is the PE ratio. We had said again, it shows how much investors are willing to pay per dollar of reported profit, which means that the higher this ratio, the better. If this ratio is improving over time series, the company is doing well. If this ratio is higher than industrial average cross-sectional analysis, the company is doing well. All right, the next ratio we want to look at is what we call the book to market. The book to market. The book to market ratio is basically the price divided by the book value per share, the book value per share. So it's important for us to calculate the book value per share. The book value per share is equity divided by number of shares, which is $32. So accordingly, the market to book ratio is going to be the price, which is 49 divided by the book value, which is 32, and that will give us a market to book of 1.5. 1.5. Okay, so for comparison, we had already said the higher the better. So time series, the company is going the right direction, so which is good. But as far as cross-sectional analysis is concerned, the company is doing poorly. They are performing below industrial average in both their price to earning ratio and the market to book. Market to book. All right, so those are the different ratios that we have looked at. A good way to be informed by these ratios, as we have seen, is to do both time series and cross-sectional analysis. All right, the next assignment we have in this chapter is the common size statement. We'll look at common size for balance sheet and the common size for the income statement. The common size is very important because it shows items as a percentage of a measure item within the balance sheet or the income statement. A major advantage of common size statements is that they help to facilitate comparison. So for the balance sheet, it is going to facilitate comparison of balance sheets over time and across companies. So as far as the balance sheet is concerned, we can calculate the common size balance sheet, which on the asset side, we will divide every line item by total asset. So we divide all items by total asset. So if we take total asset divided by total asset times 100, we have 100%. If we take the cash that was given divided by total asset times 100, that will leave us at 1.2%. So if we look at something like the net fixed asset, we can see clearly that the company has a higher proportion of net fixed asset than the industry. So the net fixed asset is at 74%, while that of the industry is at 60%. All right, so that is the asset side. Again, to calculate the common size for the asset, on the asset side, we divide every item by total asset, and then we multiply it by 100. On the liability side, we divide every item by liability and equity, and then we times it by 100. That's why we find that if we take the number of total liability and equity that was given divided by total liability and equity, that will be 1 times 100, that will be 100%. So this is the liability side of the balance sheet. We can look at some things. We can see that if we add this and this, which is note payable and the long-term debt, we will find that the total debt is 24%. It's 24%, which is high compared to the total debt of the industry, which is at 15%. So this is 22 plus 2, which is 24% total debt for the company. For 2020, for industry, total debt is 15%. So we can see how once we do common size statement, it can help us to do comparison over time and with the industry. Again, the common size balance sheet, on the asset side, we divide every item with the total asset and multiply it by 100. The liability side, we divide every line item figure with total liability and equity, and then we multiply it by 100. And that can help us to interpret. So as we have seen, the company has a higher proportion of net fixed asset than the industry, and the combined percentage of net payable and long-term debt is 24% and for the company, whereas that for the industry was at 15%. So the company is more into debt. All right, the common size income statement. So we've seen common size balance sheet, the common size income statement. We divide all items by sales. the common size income statement, they help to facilitate comparison of income statement over time and across companies. So we can look at something like the cost of goods sold. Cost of goods sold, what we find is that the company has a higher cost of goods sold. Something like other expenses, we can find that the company tend to have lower other costs. Something like net income, we can find that the company has less profit margin, and which we can argue that this is due to a higher cost of goods sold. Is due to a higher cost of goods sold. So less net income, one of the reasons is a higher cost of goods sold. All right, so the company's profit margin is less than the industry average. We have seen that. The company has lower other costs, but it has much higher cost of goods sold, which we have seen. All right, the last thing we want to do in this chapter is what we call the DuPont analysis. The DuPont analysis. The DuPont analysis is an equation that actually focuses on three things, what we call the expense control, which is the profit margin, and what we call asset utilization, which is total asset turnover, and the debt utilization, which is equity multiplier. So if we go back to the various ratios we have computed, under profitability, you will see we calculated profit margin. Under asset management, we calculated total asset turnover, and we calculate equity multiplier. So the DuPont equation brings all of this together. It shows how these factors can be combined to determine the return on equity. So we have the simple version and the extended version. So with the simple version, I think we already discussed it. It's a bit messed up here, so I'm going to write it out. We have said before that return on equity is equivalent to net income divided by equity. We can express this as net income divided by total assets times total assets divided by equity. And if you look at this second line, it is actually the same like the one on top, because as I said before, I can cancel out this total assets. And if I do that, we will have net income divided by equity, which is basically return on equity. So again, notice that net income divided by total asset is return on asset, and this is times total asset divided by equity is what we call equity multiplier. So our return on equity is return on asset times equity multiplier. So equity multiplier or financial leverage help to boost return on equity once it is multiplied to return on asset. So that is the short version. The extended version will be, we can pick up from what we have, return on equity, which we said it is net income divided by total assets times total assets divided by equity. So we can break the second part even further. So this is net income divided by total asset times. So I can insert sales here divided by total asset times. I can put total assets divided by equity. So if I do that, I'm actually breaking this first one. I'm breaking this first part of the equation. So this is net income, sorry, let me cancel this. I'm breaking the first part, so this is going to be sales. So this is net income divided by sales times. So notice that this is the part that I'm breaking. I'm breaking this part because if I cancel the sales, so I end up with net income divided by total asset. Okay, then this last part remains the same. Okay, if we go back to the computation, net income divided by sales is what we call our profit margin times sales divided by total asset is what we call our total asset turnover. And then total asset divided by equity is what we call the equity multiplier. All right, so that is the extended version of the DuPont analysis, the extended version of the DuPont analysis. So the extended version is that return on equity is equivalent to profit margin times total asset turnover times equity multiplier. And if we use that, we can go to Winnie that we calculated. You will find that our profit margin was 5.9. Our total asset turnover was 1.320, and our equity multiplier is 1.563. When we multiply all of that, we end up with 12.2. And if we go back and look at when we calculated return on equity separately, we will discover that we had 12.2. So DuPont can be used to estimate the impact of operating changes on return. So we can see the impact of profit margin, total asset turnover, equity multiplier, the impact of that on return on equity. If we change any of those, we can see how that is going to affect return on equity. All right, so the last thing is potential problems and limitation of ratio analysis. When we do ratio analysis, we do comparison with industry average. The truth is that sometimes it is difficult if the company operates in many different, if the company operates many different divisions. So it is now hard to fit that company within a particular industry. Another potential problem is that there are seasonal factors that can distort this ratio. Another potential problem is window dressing techniques. Management could do things that can alter some of these ratios. Another potential problem is the different accounting and operating practices that can distort comparison of these ratios. All right, so that is the end of this chapter. Thank you.